Okay, welcome back to Accounting 101. Today we are going to embark on our lecture and discussion of Chapter 9. In my mind, the easiest chapter in the textbook, and if not, at least one of the easiest chapters in the textbook. Chapter 9 is entitled Plant Assets, Natural Resources, and Intangibles. They mean intangible assets. The big uh, topic in the chapter is how we allocate the cost of these assets over their useful economic lives. Um, these three classification of assets have one thing in common. They are all assets that more than likely are going to benefit more than one year or more than one accounting period. Plan assets refers to the things that we saw in Chapter 4 on the balance sheet as property, plant, and equipment minus the property. No real estate, no land. Land is not subject to depreciation, and we'll talk about that in a little bit. But plant as a property, plant, and equipment. So machinery, vehicles, furniture and fixtures, all that stuff, land improvements. Natural resources refers to things that are extracted from dear Mother Earth. Gas, oil, coal, gold, silver, copper, aluminum, bauxite, lumber, cutting trees down for timber, standing timber to cut it down, to mill it into, cut it up into dimension lumber. And intangible assets, if you remember anything from Chapter 4, are those assets that do not have a physical characteristic or property about them. Things like patents, copyrights that are a enforceable right. Assets nonetheless, but assets that we cannot touch. Okay. And again, these assets all assets help us generate revenues. So the thing what we want to do is we want to allocate the cost of these assets over the period of years, the number of years in which they help us generate revenues. So, thus preserving the matching concept. And as we'll see a little bit later on when we get into the different ways to compute depreciation, we need three pieces of information, two of which are estimated. So, depreciation, in general, there's also, we're going to get into each one of those has a specific term used, but it's all the same thing, the allocation of the cost over the life of the asset. They all help us generate revenues. I'll give you an example. If we were wanting to start an airline, I think a 737 goes around $46 million. And let's say it's going to last us 10 years, and we're going to take people from Northeast Pennsylvania down to Orlando, Florida, for obvious reasons. There's a good destination down there, I'm told. Well, if we would subtract the cost of the asset, and let's say every year for 10 years, our revenues are going to be $10 million. All right. So over the course of 10 years, and let's play economist here for a while, that there's no other cost, just the cost of the airplane, no operating costs. So in year one, if we would expense that, we would have $10 million in revenue and $46 million of expenditure for the airplane, cost of the aircraft. And that would give us a net loss of $36 million. But if we said $46 million, it's at the end of 10 years, we could sell the airplane for $20 million. So we're going to depreciate or use up $26 million of it equally. So $2.6 million each year. So each year we're having $10 million of revenue, less the $2.6 million. That would give us $7.4 million in net income each and every year. Now, if you looked at the 10 years, the whole thing would equal out. But if you expensed it in the year you bought it, you would have a big net loss. And then all the other years, you would have a $10 million net income. So it distorts the measuring of income on the income statement. So accountants came up with this way to allocate the costs of these assets over their useful economic lives. Let me just jot something down here on my clipboard and put it up on the screen for you. And when we're talking about these three different types of assets that are sometimes referred to as long-term assets or fixed assets, I said the allocation of the cost over the asset's useful economic life is going to be allocated. And when we're talking about plant assets, that allocation is called depreciation. Okay. When we're dealing with natural resources, things that are extracted from the earth, mined, or harvested, we call it depletion. That up there for you. And when we're dealing with the intangible assets, things like patents, copyrights, trademarks, and the such, the term we use is called amortization. All right. So those three terms are specific to those types of assets. But those three terms, although they are not interchangeable, they are, as we'll see later on in the chapter when we compute them, the same darn thing. It is a way to allocate the cost of that asset, once again, over its useful economic life. By now, you should know that by memory. I've said it so many times. Okay, let me advance the page here. Got a little bit of ground rules we have to sort out here. Now, the cost of an asset, one of these what we call long-term assets, or assets that are going to have a life greater than 1 year, is not just the purchase price of the asset, but anything we have to expend in order to get that asset situated and up and running as intended. In the case of a machine, sometimes you have to have it installed in the factory floor. It's got to be perfectly level. It might have to be put in a room that is environmentally controlled as far as temperature and humidity within certain ranges. All those costs of the HVAC people, the carpenters to set it up, or the installation crew, whatever, is going to be put into the cost of that asset and depreciated over its useful economic life. I'll give you an example. A friend of mine years ago, I was going to have a couple investors, and they were going to go into the coal mining business, and they were looking to get a used steam shovel or drag line. I forget which. And I think they found one, and it happened to be about 20 or 30 miles over that way. And I think the people that owned it wanted $350,000 for it. Well, they needed it 30 or 40 miles over that way. And you can't drive those things on the road. They're too big and they would damage the road and all. So they had to hire a crew of, 5 to 10 people to semi-disassemble it, put it on flatbed trailer trucks, haul it up to where they needed to be, and then reassemble it. And that took like a week or 10 days and was about $50,000. So the cost of that drag line or steam shovel, I forget which it was the $350,000 purchase price plus the $50,000 they had to pay to have it disassembled partially, transported the pieces, and then to where they wanted it to be, where their mining property was, and then reassembled. If you have a machine that is going to be used in the manufacturing process, any raw material you run through that machine as part of the calibration of the machine and getting it ready to up and running as intended is going to go into the cost of the asset. Okay, so it is more, when we say the cost of the asset, just keep in mind that it is more than the purchase price. Say, for instance, you wanted to have one of these food trucks. Well, let's say you go out and you buy a food truck for $45,000, but then you have to you want to put your logo and you want to put a paint job on it so people, catch people's eyes and they'll stop by and be interested. And, let's say that, again, the van costs you $45,000, fully equipped with all the kitchen stuff in it. but the paint job was another $5,000. Well, the cost of your asset is now $50,000. Okay, so that gets what we call capitalized. Now, there's two types of expenses the textbook talks about here in chapter 9. Two types of expenditures, I should say. One is called capital expenditures. The other one is called a revenue expenditures. Okay. So what's the difference, you ask? Well, a capital expenditure is an asset. The other type of expenditure is called a revenue expenditure. So it's going to be charged to an expense account. They both get debited to their respective account, but one is an asset, so it's going to have more permanence. It's going to last longer than 1 year, whereas the revenue account expenditure, the revenue expenditure is going to go to an expense account, and it's going to get closed out, as we learned in chapter 4, each and every time we do financial statements every year. Okay, so I didn't make them too good looking here, but again, they're in the book. There are two types of expenditures. Capital expenditures are assets. Revenue expenditures go to expense accounts. So the capital expenditures, since they're assets, are going to show up on the balance sheet. The revenue expenditures, since they're expenses, are going to show up on the income statement. I just had a phone going off, but I have someone here that's going to answer it for me. Thank you very much, phone person. Okay, where were we with that interruption? Talking about the two different types of expenditures. Let's look at a couple examples so we can get a little bit better understanding of this. Let's say you have a factory or a warehouse and you have a leaky roof. If you go up and patch the roof, fix the leak, that's sort of like a routine repair and maintenance type deal. And yeah, let's say it's $50. Charge it off as an expense. Well, the whole roof, that's a capital expenditure. Okay. Same thing with we used the example before of the aircraft. The fuel you put in the aircraft every time you fly, you got to top it off. That would be a revenue expenditure. Okay. If we took off the two engines and replaced them with new, more efficient engines, or just had them taken off and redone, overhauled, that would be a capital expenditure. Okay, it would go to the asset account. Again, trying to think of other examples. If you trucking company, over the road trucking, these big diesel trucks that pull the trailers up and down the interstates. Oil changes, washing the truck once a week, once a month, whatever, putting tires on it. Those would be revenue expenditures, be charged to an expense account. If you had the engine overhauled or rebuilt and or the transmission replaced, that is a capital expenditure. The rule of thumb is there's three criteria if you want to look at whether an expenditure should be capitalized or charged to a revenue expense account. If the expenditure increases the life of the asset, is number one. Number two is if it makes the asset more efficient. And number three, if it increases the residual or salvage value of the asset, then that expenditure is a capital expenditure. Now, I'm going to tell you something. I don't know if it's going to help or confuse you, but all expenses are expenditures, but not all expenditures are expenses. I'll say that again. All expenses are expenditures, but not all expenditures are expenses. Yeah, I know it's a little funny thing, but why do we say that? Because the expenditures that are going to benefit more than one period are what we call the capital expenditures, and they're going to be debited to an asset account instead of an expense account. All right, let me look at this great electronic textbook that I have trouble navigating, so bear with me a little bit here. I can't get it to. It doesn't. There we go. Fourth try, it starts responding. Okay, as we said earlier, think going back to chapter 4 earlier in the semester, the classified balance sheet, we have the current assets. Well, no current assets are ever subject to depreciation, depletion, or amortization, because by definition, they're going to only be around for a year or less. So only assets that have a useful life greater than 1 year are going to be subject to depreciation, depletion, or amortization. Land is never subject to depreciation, because one of the components we need to compute depreciation is an estimated life, and land has an indefinite or infinite life. So if you know anything about mathematics, if you have infinity in the denominator and again, we haven't seen the formula, we'll get to it in the next 15-20 minutes. If you divide the depreciable basis of the asset, which is its cost less its residual or salvage value, by its useful economic life, you get the depreciation under what we call the straight line method of depreciation. If you had infinity in the denominator of that equation, it's a mathematical impossibility. You can't answer it. Okay? That's why land is never subject to depreciation. However, things called land improvements are subject to depreciation because they have a limited life. Okay? What would constitute land improvements? I'll use another example of another friend I had who had a funeral parlor business. He was an undertaker, a mortuary, he had a degree in mortuary science. He needed more parking to accommodate his growing business. Well, across the street from his funeral parlor, there was an old house, and the family, I don't know if they passed away or moved, or he bought the house. He had to pay to have the house torn down. He had to pay to have the basement filled in with, fill, and then he was able to put the asphalt down for the parking, put a light in it, or a couple lights, and have the lines painted for the parking spaces. Well, the cost of the land was very expensive. It was a very expensive parking lot, but he needed it. The cost of the house, plus the cost to demolish the house, plus the cost to fill in the basement with fill, all get capitalized into the account called land, or land for parking lot. Okay, the only thing subject to depreciation would have been the paving, the asphalt that he had paved, the lines painted on the asphalt for the parking spaces, and the lighting fixtures. As you can see, the land is always going to, come back in 5-10 years, or come back in a couple thousand years. That land more likely will still be there. It might be underwater, but it'll still be there. However, that asphalt is not going to be there. It's going to take wear and tear from the weather. It's going to have to be repaved, 10, 12, 15, 20 years. The lines are going to have to be repainted more frequently than that because of the ultraviolet. And the lighting standards are going to rust and rot, and maybe the wind will blow them and just get weathered. And so those things are subject to depreciation. Another way you can look at depreciation is it's a way to look at the loss of utility or the loss of value of an asset. Okay. Now, it in no way, shape, or form provides funds for the replacement of the asset, nor does it do anything about valuing the asset as resulting in its fair market value. Fair market values are determined by supply and demand. It will give us depreciation will give us what we call book value or carrying value, which is the cost of the asset less its accumulated depreciation to date, is what we call book or carrying value. And that's an important number, but only important in the fact that that will be the basis we use to determine whether we have a gain or loss or break even when we get rid of the asset, when we dispose of it. And we'll talk about that more later on in this video. And we'll see it in practice when we do the accompanying video for the exercises and problems and short exercises at the end of the chapter. Okay. Over on page 9-3 is what I just was referencing. How does one measure the cost of the land? They have there the purchase price, the brokerage commission you pay, survey and legal fees associated, delinquent property taxes you might have to pay, taxes assessed to transfer the ownership of the land, the title, transfer tax, cost of clearing the land or removing any unwanted buildings, like I used the example of the undertaker I knew. Cost of the land does not include the following: the fencing, the paving, sprinkler system, lighting, signs, and things like that. Sidewalks, fencing, signage of subject to depreciation. The cost of the land is not. So they show you there at Exhibit 9.2 how they did it. Cost of the land, $50,000. Property taxes, $4,000. Transfer taxes, $2,000. Removal of building, $5,000. Survey fee, $1,000. Add them all up, and the amount to capitalize, the amount to put in the asset account called land, in this example, $62,000. They show the entry there. They paid $12,000 cash, the rest with a note payable, and the land goes into the asset account called land, credit the liability note payable, and credit the asset cash for the check you wrote. Right there underneath that, you can see in the purplish type, I don't know what type it is in your book. In the ebook, it's sort of a purplish. Capitalize. Capitalize means that an asset account was debited, increased. Capitalize. We talked about that a while back when we talked about the two different types of expenditures. Okay. Okay. Buildings. You can buy a building or you can construct a building. Over on page 9-4. Purchase price plus all the costs to renovate the building to get it ready to use, which may include anything, putting in a new lighting system, ventilating, heating, air conditioning system, putting in new walls, new stairs, new garage doors, whatever you need. Okay. That would all be capitalized. If you construct the building, the architectural fees, the building permits, the cost of the contractor for his labor and materials would go into the asset. It would be capitalized. One thing missing here, and it's more for an intermediate accounting course, is the loan you would have during construction. You can actually capitalize some of the interest cost on the building before it is occupied. It can go into the asset, as opposed to being, once it's done being built and you're occupying it, the interest is then a revenue expenditure as you're paying off the mortgage. Let's see. Oh, come on. Trying to turn the page again. There it goes. It's electronic. I can turn a page in the physical book faster than I can electronically. Next topic they talk about is machinery and equipment. So once again, the point they're trying to make is it's not just the purchase price. Here we're saying purchase price less any discount, transportation charges to get it where you want it, insurance while in transit, sales and other taxes are going to be capitalized. Commission you pay for the salesperson that sold it to you, installation costs, testing prior to the use of the asset, calibrating the machinery. That would all go into the asset account. None of those would be expensed. They will get expensed eventually through depreciation. And if you remember chapter 3, we would have those accumulated depreciation expense, debit, credit, accumulated depreciation. That's the entry we use when we're doing our adjusting entries at the end of the year to account for depreciation. And they talk about furniture and fixtures. Again, that's just a different, another classification of plan assets. Lump sum purchases. Sometimes a company will buy existing business. Let's say you got 10 acres of land, you've got 3 buildings on it, an office building, a manufacturing plant, and a garage. And you got various equipment in the office, you got various equipment in the plant, manufacturing facility, and you write one check. Well, how do you divvy it up? Well, what we would do, the best way to do it is to get an appraisal of everything, itemized appraisal of everything you bought, add it up, and that's going to be your total. And then you take each assets, each identified asset's fair value, appraised value over the total appraised value of all the assets, multiply that against the lump sum purchase price, and that's the amount we will assign to each asset. It's called the relative market value method. Okay. It's reasonable, it's logical, and it gives fairly good results. Okay. Very rarely will the amount of the price you paid, the lump sum, and the appraisal will be the same. I'll give you a couple examples there. You can read them at your leisure. No need for me to go over things that are just numbers and examples. Okay. Capital and revenue expenditures, we talked about that, so I was a little bit out of order, but we had a nice segue when we were first getting introduced to the plant assets, natural resources, and intangibles. Okay. And sometimes it's, when we do the exercises and problems and even some of the review questions, I think we have one here picked we have to decide which one it is. And usually it's kind of easy to determine, but once in a while you have something that's, in the gray area or borderline. And some companies will just have a arbitrary figure that they use. If it's $1,000 or $2,500 or less, regardless of how long it's going to last, they're going to expense it. I'll give you a good example. A carpenter gets a good hammer. Carpenter hammer, I don't know, let's say $50 for a good hammer. Well, that hammer is going to last a long, long time. They can take a beating, okay? And theoretically, it should be depreciated over its useful life back in the 1950s. So, back then it was probably $5. It would be ridiculous because the amount of depreciation would have been like 10 cents a year. So the cost benefit rule comes into play here, where if it's going to cost you more to compute the depreciation and do the entry, just expense the darn thing. It's not material, $50 hammer. Yeah, it's going to last more than 1 year. So yeah, theoretically it should be depreciated. But from a practical point of view, it's not going to make any difference in the financial statements, whether the balance sheet or the income statement. Okay. Again, the three rules I went over to you: when you have something that's sort of like in the gray area, ask yourself, is it going to increase the life of the asset? Is it going to make the asset more efficient? Or is it going to increase the salvage or residual value of the asset? If you can answer yes to any one of those, it would tell you that it should be a capital expenditure. Okay. They have a thing here. Extraordinary repairs are capital because it extends the asset's capacity or useful life. Underneath that little tan box there where they show the entry for it, they said ordinary repairs are called our revenue expenditures, debited to an expense account. Because they occur, again, another thing you want to use as a rule, it's not a hard and fast rule, is how often does it occur? If it occurs once a year, but just about every year, or several times a year, expense it. If it's something that occurs every 3 to 5 years or longer period, probably be better off capitalizing it. Again, keeping in mind the dollar amount involved, whether it would be worth it or not. Exhibit 9-3 gives you some examples of a capital revenue expenditure. They were using looks like a delivery truck, major engine or transmission overhaul, modification from their use, additional storage capacity, anything that increases the life, or be capitalized. Revenue expenditures, repairs, general repairs, oil changes, replacement of tires, windshield wipers, even a paint job. You might make an argument for the paint job should be capitalized. Again, depending on, you can go somewhere and get a cheap paint job, or you can get a very elaborate one if you want to. Again, if you're going to use it from a marketing standpoint to attract customers, then you might want to make an argument that it should be capitalized. Treating a capital expenditure as an expense or vice versa creates an accounting error. If you don't believe me, go look up the case of WorldCom or MCI Communications. They were they were capitalizing things that should have been expensed. So what are they doing? They're lowering expenses. So what does that do? Increases net income or decreases the net loss. So it makes the company look like it's performing better than it really is. And also, it's a double whammy because it's creating assets that don't exist. Things that shouldn't be capitalized are being capitalized. So it's making the balance sheet look stronger. And that's why the chief executive got to spend some time, a couple years vacation at the expense of the federal prosecutor's office. Bernie Ebbers was his name. He was the first corporate executive to go and serve jail time. Before that, they just fined him. Let's see. I guess it's going to be time again to try and turn the page. I clicked it there. That's not okay. Depreciation. How is it computed? All right. I'll try and find a pen that's a little bit. We have, our textbook shows us 3 ways to depreciate, 3 methods. The first one is called the straight line method. And all this will also appear in the highlights I send out. The production method, sometimes called the units of production. AKA the units of production. And the declining balance method. And there's 2 variations using 150% or 200% of the straight line rate, which we'll get to shortly. All right, so there I have the 3 listed. The top straight line method, usually referred to as a capital S/capital L straight line method. The production method, or sometimes referred to the units of production method. And those computations, once I get my clipboard back down and put the formulas up, you'll see are 99.99% identical. And then the third one, the declining balance method, is a little bit different. And we'll talk about that in a few minutes, the differences. So the first one, like I said earlier, you need 3 pieces of information to compute depreciation for the first 2 methods anyway. You need the cost of the asset, less its residual value, sometimes called salvage value or scrap value, divided by its estimated life in years. I should put here estimated residual value. So there's a formula up here. The cost, and again, keep in mind the cost is more than just the purchase price, less the estimated residual or salvage value, that is what we think we can get for it when we're done using it, divided by the economic useful life in years. The example they give in the textbook is I believe a pickup truck that they say costs $41,000 and has a residual value or salvage value of $1,000 and is estimated to have a life of 5 years. That means our depreciation on that truck would be $8,000 per year, each one of those 5 years. So there's the computation I have right here, straight line method. There's the cost, 41,000, less the salvage value of 1,000 is, the numerator is what we call the depreciable basis, or the depreciable amount of the asset, divided by its economic life of 5 years. 41,000 minus 1,000 is 40, divided by 5 years, 8,000 per year. Now, that is for a full year. If we didn't have the truck for a full year, if use the common rounding, if we buy it in the first 15 days of the month, you count that month. If you buy it in the last 15 days of the month, you start counting with the next month. So let's say we bought the truck on July 1. So that first year, we only had it 6 months or half a year. So we would only take 1/2 of a year's depreciation. So we'd have to prorate that $8,000 for the half year and only get an adjusting entry of $4,000 to depreciation expense, $4,000 credit to accumulated depreciation. Okay. Now what the straight line method does is, hey, once you calculate it, it's that each and every year. Now again, at the end of the trucks, so the truck would be depreciated over 6 calendar years. Let's see, first year half, second year would be full, 1, 2, 3, 4, 5. Yeah, over 6 years. A 5-year life, because we have the first period is a half year and the last period is a half year. And then we have 4 full years in between at 8,000 a year. So 4,000 the first half year we own it, a full 8,000 in year 2, 3, 4, and 5, and a 4,000 in the last half year we are depreciating the vehicle. Now, every time we have an asset subject to depreciation, and I'll use the example they're giving in the book, we're going to have an account that modifies or values the truck. So I'm just going to put here truck, handy dandy T account I've drawn here, and next to it, each asset subject to depreciation is going to have an accumulated depreciation account. And if you have more than one truck, you can designate them truck 1, truck B. Use it. You want to give them names, give them names. Here's the asset. Here's the accumulated depreciation that modifies that truck. So we have 41,000 in there. And if we had it the first year, 1, 2, 3, 4, 5. That's what it looks like after the end of the first year. So we have $41,000 in the asset account. And that's kind of neat, because as long as we have that truck, we're going to have that asset account, and we can always go back and see what we paid for the truck when we initially purchased it. And we can also go to its corresponding accumulated depreciation account and see how much we have depreciated. So at the end of the first year, the net amount of the truck, or what we call the book value or carrying value of the truck, is the 41,000 minus the 8,000, and that would be what, 33,000? So yeah, $33,000 is the book value, carrying value of the truck. I'm going to fill in years 2, 3, 4, and 5. And then we're going to see at the end of year 2, our balance here would be 16,000. So the book value would have been 25,000. All you do to get book value or carrying value is subtract the accumulated depreciation from the cost of the asset. Let me write that down. Book value, also known as carrying value, equals cost of the asset less its accumulated depreciation. I'm just going to abbreviate DPR. Okay. So to get the book value or carrying value of the truck, all we do is take the cost of the asset less its accumulated depreciation, and that'll give us the book value or carrying value. It's going to change every year. But look what happens. After 5 years, the truck is fully depreciated. We have $40,000 total balance in the accumulated depreciation account, 5 times 8,000, 5 years at 8,000 a year. So here's the cost of the truck, 41,000. Here's all the accumulated depreciation. So the book value of the truck is $1,000, which is what we started out with as a estimated residual or salvage value. Always will be that because it is a mathematical formula. Now the production method or units of production method, using the same example they give in the book, is the same formula, except the denominator now, in this case, it's going to be in some type of units other than years. And what that's going to do is give us a rate. And in this case, it's going to be miles driven. Okay, estimated life in miles. I screwed up and I wrote a name. I got to get the other computer up. Okay, the production or units of production method, the formula is nearly identical. The only thing that changes is the denominator. And really, I don't know if you can call it a change because it's still the life, but in terms of years. In this case, in the truck, they say the truck has an estimated life of 100 miles. So let's plug those into the formula. Again, we'll have the cost at $41,000 less $1,000 estimated residual or salvage value over 100,000 miles. That's going to tell us the truck, the depreciation on the truck is going to be 40 cents a mile. So we're going to have to know how many miles we drive each year. Well, there's that little thing in the middle of the speedometer called the odometer, O-D-O-M-E-T-E-R. And you just read that at the beginning of every year and you read it at the end of the year. And you find out how many miles you drove the truck. Let me get the other computer up here. Okay, so that if the example in the book, let's see, what are they? They give us the mileage the truck was driven each of the 5 years we owned it. Let's double declining balance method. Okay, Exhibit 5-9 is a table they have for the straight line method. You can see there that each year the depreciation expense is $8,000. You would have the corresponding credit to accumulated depreciation for the same amount. Remember, however, the depreciation expense account gets closed out each year as part of the closing process. It's an expense account. The accumulated depreciation account is what we call a contra asset because it goes against the asset account. It does not get closed out. So it gets every year. It gets. I showed you on the other paper with the straight line method. To get the book value, you'd add up each year 8,000. So the second year, the accumulated depreciation total would be 16. Third year would be 24. Fourth year, 32, and the fifth year, 40,000. Now let's get back to the units of production method here. It's a two-step process. They show you there. You figure out a rate in step one, which I had the cost less residual value divided by the useful life in units. Comes out to 40 cents a mile. And then all you have to do is multiply how many miles you drive times that 40 cents. That 40-cent rate will be constant over the life of the asset unless we do something to change the asset or the estimated life. Then we recalculate from that point forward. So they're telling us in years 1, I'm going to do a little bit different table, the same that they have in the book, but I'm going to do it a little bit differently here. Year 1 through 5, and then miles driven. What do we have here? 20,000 miles, 30,000 the second year, 25,000 in year 3, year 4 and 5, 15 and 10 respectively, 15,000 and 10,000 respectively. And then I'm going to put in here the rate, 40 cents a mile. So then I'm going to get the depreciation expense for the year. Okay, so I've got my years. 1, 2, 3, 4. I have the miles was given in the textbook, and I have the 40 cents, and I ditto marks all the way down. So you just multiply that 40 cents times the 20,000 miles in year 1, and you get $8,000. Same amount as you got from the straight line method, merely a coincidence here. 30,000 miles times 40 cents is 12,000. So in year 2, we get more depreciation. In year 3, 25,000 miles, we come out with $10,000 expense for the depreciation on the truck. 15,000 miles in year 4 would be 6,000. And in year 5, 10,000 miles, or times 40 cents a mile, 4,000. Notice that those will add up to 40,000. The amount, the depreciable basis of the truck, the depreciable amount. So here was the miles driven. The 40-cent rate is constant. Just multiply the two to get 8,000, 12,000, 10,000, 6,000, and 4,000. And again, end up with $40,000 of depreciation over the years. So each year you'd add, whatever year you wanted the accumulated, you would just add the current years to the previous, and that gets your accumulated depreciation balance. And you can compute your book or accounting value. And notice that you still end up with $1,000 residual value. Okay. Now, the one that's a little bit different, the declining balance method. Let me scroll down here. Let me make one comment about the units of production method and the straight line method. The straight line method gives the same amount of depreciation each and every year. That's hence the name, straight line, constant. The units of production varies depending on how much you use the asset. In this case, we saw that there were no 2 years that had the same number of miles driven. Okay. Because of that, the units of production probably most closely resembles the use of utility of the asset. In this case, the pickup truck. Trucks wear out. You find a low mileage vehicle, it'll probably command a higher price because there's more life left to that asset, especially with vehicles. Now, the declining balance method, and the book concentrates, and most books concentrate on what we call the double declining balance method, or DDB. Double declining balance method. All right, DDB, double declining balance. So the first thing you want to do with the declining balance method, whether it's 150% or 200%, is you take the straight line, the estimated life used for the straight line method, or in this case, it was 5 years. Make a fraction out of it. Put a 1 over the top of it. Okay? And now you can convert that to a decimal. 0.2. 1/5 is 0.2, or 20%. Okay, that's the straight line rate. But we're going to use double that, double the decline if it's 200%. If it's 150% declining balance method, you'd multiply that by 1.5. But the book and most books just use the double declining balance method. So multiply it by 2 for 200%. We get 0.4 or 40%. All right. So that's our depreciation rate. Now, the declining balance method, whether it's 150% of the declining balance or 200% of the declining balance method, the declining balance method is what we call an accelerated depreciation method. Which means we're going to charge more depreciation in the earlier years of an asset's life and less depreciation in the latter years of the asset's life. And some people may argue, rightfully so, that that's how things really depreciate. Especially with vehicles. As soon as you title them and drive them off the showroom floor, they depreciate quite a bit. Okay. With the declining balance method, the formula is the carrying value, which is also book value, those terms are interchangeable, times the rate, okay, equals depreciation expense for the year. Okay, there's the formula. Yeah, I wrote it out. It doesn't look like a formula, but it's just the rate we've determined, in this case 40%, because we had a 5-year life estimated life on the truck. 5 years, 1/5 is 20%. We're using double, so it goes to 40% or 0.4. And we just multiply the current carrying value or book value of the asset at the beginning of the year by that rate. Okay, so we had $41,000 at the beginning of the year is the carrying value because there is no accumulated depreciation, times 40%. So this would be year one. I'll get my handy dandy calculator here. 41,000. Exactly, minus 40,000. Oops. $16,400. All right, let me advance the page here a little bit. So, let me set this up a little bit better. 3, 4, 5. Now, I'm going to make myself a T account for the truck down here. And the T account for the accumulated depreciation, which I'm going to just abbreviate ACC DPR. And over here, I'm going to just make a note of book value. End of year. So at the end of year, minus 16,400. The book value at the end of the first year, which is also the book value at the beginning of the second year, is $24,600. And all that is the cost of the asset less its accumulated depreciation to date, $24,600. Okay. So that's the amount we're going to use for year 2. Year 2, the carrying value is now, I had it up here, book or carrying value times the rate equal depreciation expense for the year. Okay, so I put some headings on this column now. The book value or carrying value, the rate's going to always be 40%. And then what we get when we multiply the rate times the beginning of year carrying value is going to be the depreciation expense for the year. So that's going to change. That's going to go down each and every year. Warning. Be careful. With the declining, especially with the double declining balance, when you have either a very short very short life to the asset, you're going to get a very high percentage of a rate. So you're going to depreciate it very quickly. Or if you have a relatively large residual or salvage value, you may you have the possibility, if your calculations, if you don't pay attention, of over depreciating the asset or under depreciating the asset, depending on salvage value and the life and the mathematics involved. And I think we'll see that here. When you're using the declining balance method, especially the double declining balance method, you notice, unlike the straight line method and the units of production method, where the salvage value and computation of the depreciation for the year, balance method, okay? However, we have to be aware of the estimated residual or salvage value, because we cannot depreciate the asset below that. So the residual, or if we get to the end of the estimated life and we didn't fully depreciate it, well, then in that year you have to increase the depreciation to get to that salvage value or residual value in order to hit it in the estimated life. And we'll see how that works in the example here and also in the exercises at the end of the chapter in the next video. So again, with the declining balance method, all we have to do, we have to keep track of the carrying value, because that's what we multiplied the rate against. And we also have to watch that the accumulated depreciation does not exceed the depreciable basis of the asset, the depreciable basis of the asset being its cost less its estimated residual value. Okay. So if your accumulated depreciation account has a balance greater than the depreciable basis of the asset, you've over depreciated the asset. You've got to adjust in the last year. If you do it and you don't hit it, you're short, you have to add extra depreciation expense in that last year, which I think is happening here. The opposite can also happen. Okay, let's look through this. Yeah, you can see they only have 25, 26, 27, 28, 29. Yeah, they hit the limit there, or they have to add more in. So let's work through this. So we've done the first year, $41,000 carrying value of the truck times the 40%, $16,400. So now my carrying value of the truck is $24,600, which is nothing more than the cost of the asset less its total accumulated depreciation. Now we multiply that by 40%. Well, let me throw that up here. 24,600 times the 40%. The 40% is going to remain constant, and that's going to give us $9,840. So I'm going to put that down in our accumulated depreciation account, and also what our book value would be, 14,760. All right, so what I did is I took the 24,600 in year two is our beginning of year two book value times the 40%. That gives us our depreciation expense for the year of $9,840. Brought that down to the accumulated depreciation account. So now the 41,000 less the amount from the first year accumulated, the second year accumulated, and get the new book value of 14,760. I'm going to bring that up to year three for the book value at the beginning of year three. Again, times 40%. It's going to give me a depreciation expense in year three of $5,904. There's the end of year two, beginning of year three book value times 40% depreciation expense for the year. Going to bring that down to the accumulated and calculate my new book value. That would be 8856. Okay, so if I go cost of the asset less all the accumulated depreciations, I get a new book value at the end of year three of $8,856. Going to bring that up to the beginning of year four as my book value. Times 40%. I'm going to get 3542. The book value at the end of year three, beginning of year four, times 40%, $3,542. Depreciation expense, debit. Accumulated depreciation expense, credit. And that gives me a book value of $5314. I'm going to change colors here so we can see what happens. Let's see. It's $2,126 rounded. All right. Now, the reason I did that in red, I'm gonna do a little calculation over here, and we're gonna figure out that if we did that, well, if we can see down here at year five, what do we need to get this to total $40,000? The depreciable basis of the truck. Well, here, let's look at, we had a book value beginning of year five of 5314, right? And our calculated depreciation is 2,126. Which would leave us a book value of $31,088. Well, what's the residual value have to be? $1,000. That's a 2188 difference plus the 2126. $43.14. All right, this is a little bit hard to understand here, especially with my writing. But in year 5, we calculated depreciation of $2,156. Well, we work it through, and we're going to see that leaves us with a book value of $3,188. But at year 5, we want our depreciation, our book value, to be $1,000. So I took the difference there and added the depreciation expense we calculated, and that's how much depreciation we have to charge in year 5. $4,314. 43.14. So the calculation, you always have to be careful in the last year, or sometimes even the next to the last year. I've got a skylight here. Back up. The sun is moving. That's why I do these at night usually, but I was dead tired last night. So with the declining balance method, you always have to be aware of what the residual value is, because that's the target you want to hit. You don't want to depreciate the asset below, in which case we'd have to decrease the amount, whatever the computation, the calculation gave us as a depreciation expense. We'd have to temper that. We'd have to remove some of that if we went below residual value or book value. The book value has to be equal to residual value at the end of the cycle, or sometimes before the end of the computations for the life expectancy of the asset. We might have to cut it off and limit it. The calculation will say, hey, it's $7,000 worth of depreciation, but that would take us below salvage value. So, $2,000 below salvage value. So we'd have to do limited. Our calculated depreciation expense is $7,000, but we're limited to $5,000, because if we took the $7,000 as calculated, it would depreciate the asset below the salvage value, meaning the book value would be less than the salvage value, and we don't want that to happen. Again, we'll see that more when we walk through the exercises in the textbook. Just keep in mind with the declining balance method that the residual value does not enter into the calculation for the yearly depreciation expense, but you have to keep it in mind. So you might have to adjust the depreciation in the last year or next to the last year of the asset's life to either add extra depreciation expense or to the calculated depreciation expense, or you might have to, whatever the calculated expense is, you might be limited that you can't take it all, because we want to come in at residual value and book value being equal. Oh, yeah, that's a headachy one. And again, looking towards the future, that's a tricky part. When the next exam, we're going to have a problem where you're going to calculate depreciation under all three methods, and just watch when you're doing the declining balance that there's that quirk in the last year or next to the last year, that you have to be careful that you don't under or over depreciate the asset based on the calculated depreciation expense. They do a comparison there of straight line units of production accelerated. Notice the total is the same in all three methods. It's how much each year varies, except for the year one for straight line and units of production is the same. Other than that, no two are the same. Down just above Exhibit 9.8, they look at some of the characteristics of the three different methods. Straight line generates revenue evenly over time, equal amounts each period, and a building would be a good asset to be. Hey, a company can use various methods for various assets, depending on the usage. Units of production method, depreciation due to wear and tear rather than obsolescence. More usage causes a larger depreciation expense, and limited, be applicable to vehicles and machinery. Double declining balance produces more revenue in early years, so more value is lost in the earlier years, loses its utility with time. Higher depreciation in early years, less in later. And they say a good example of that are computers, iPhones, things that get replaced quickly, relatively speaking. They show you that graphically in Exhibit 9.8. And again, management has the power to decide which method they're going to use. They should use one that is reflective of a reality. Okay. Again, this is for financial accounting. Tax accounting purposes is a completely different set of rules. They talk about it here on page 914. IRS requisition method for tax purposes is called the MACRS, M-A-R-C-S. Cost recovery is what tax people, that's their word for depreciation. Okay. They have IRS has a publication that tells you, lists all these different various assets and whether they're 3-year, 5-year, 7-year, or 39-year property. Obviously, 39-year property is buildings, although there's a couple variations of that. I think there's a 37.5. And again, if it's residential real estate, if you're renting apartment buildings versus office buildings or manufacturing buildings. And there's quirks in this. I only know this because I had a client that was in the standard-bred horse industry. A horse can be either 3-year or 5-year property, depending. Oh boy, I'm really getting bad here with the line. Of course, that's only temporary as the sun is moving. Depending on the age of the horse could be either of two categories. So again, hey, it's the IRS, it's government. What could I tell you? Again, that's tax accounting. In fact, tax accounting will allow, under Section 179, will allow a business to expense assets up to $1,050,000 a year. Again, they have to qualify for certain types of assets, and I believe it's maybe limited to listed or non-listed property. Again, that's tax stuff. You don't have to know that because this is a financial accounting. Of course, just know that tax depreciation is different from financial accounting depreciation. Partial year depreciation. Obviously, you have to prorate it for part of the year. There's another method of that used to be taught. It's not in our book. Called the sum of years digit. So if you had a property that was a 3-year property, you'd list the number of the years and count down. 3, 2, 1 would be, and first year would be 3/6, second year would be 2/6, and last year is 1/6. So it's accelerated method. A 5-year property, you'd have 5, 4, 3, 2, 1. So 5, 4 is 9, 3 is 12, 2 is 14, and 1 is 15. So first year would be 5/15. Second year would be 4/15, 3/15, 2/15, and 1/15 going each successive year. And because of that, you'd have to change the fraction if things, you'd have 2 rates for a given calendar year. And this is not working out good. I don't know how long it's going to take. Maybe I'm going to shift over here. All right, I gotta move some stuff here. Oops, just lost the power cord. Battery should be good. Probably do all this and only have another 5 minutes or so. Well, now you got to see the backyard from a different angle. All right. Again, we discussed this a little bit earlier with the pickup truck. You know, we're assuming that it was bought on January 1st. So whenever you're computing these depreciation methods, other than the units of production, because units of production is independent of time, it's based on how many units you've done times a rate. So you don't have to prorate it with the units of production because, you know, if you only had 3 months or 7 months or how many months in 10 months in a year, it's how many miles you drove. It's not a function of time. Declining balance, straight line, you have to prorate for the part of the year. Okay. The other thing we want to do here, chapter 9, is when we have a disposition of an asset. Now, we got to talk about depletion and amortization, but we've got a lot of that covered already. There are times when we could say we got an asset and we thought it was going to last 7 years, and after 3 years we're saying no, it's going to be, that only has 1 or 2 more years to go, or the salvage value estimate was off. We can correct that currently, meaning in year 3 or whenever we become aware of the information that the life is going to change or the estimated salvage value is subject to change, we change it when we become aware of the change and do it prospectively from that point forward. We don't have to go back and recalculate the years that have already been done. The years that were already done was done using the assumption as we use the best estimates we had at the time. As we get nearer to the end of the asset's life, we get a better, clearer picture. We can revise the depreciation computations based on the new estimates. Okay. I'll give an example there. Using the chuck again. The remaining depreciable book value, you recalculate based on the new information. So, the next section, I think, is the disposition of assets. Come on. Okay, 1 page. Oh, no, I'm sorry. Reporting property, plant, and equipment. It's shown on the balance sheet with the original cost less its accumulated depreciation. Again, we're giving information to decision makers. Looking at Exhibit 9.9, I can see, hey, we have a building there at $60,000 and its accumulated depreciation is $250. I know that that building has not been depreciated a whole lot. I can assume that it's new to that business. It may not be a new building, but again, it's very early in its estimated life. Looking at the furniture there, I guess, yeah, then this is Smart Touch Learning. $18,000 for furniture, accumulated depreciation $300. Again, not a whole lot of accumulated depreciation, so it is very early in its economic life. Okay. That's one way of showing it. On the left-hand side, the condensed treatment number 2, they show to the right of that in figure 9.9, is they just show it net amount, and they say see note 8. Well, note 8 would show you the detail of the original cost of the assets less their respective accumulated depreciation. So you'd have a supplementary schedule in that note showing what is to the left of it. Cross my fingers and try to turn the page. Disposal of plant assets. They say there's three ways you can do it. Discard the plant asset, sell it, or exchange it for another plant asset. Okay. Well, if we discard it or sell it, again, whatever we're getting for it versus compare that against its book value or carrying value will determine whether we have a gain, a loss, or if we break even on the disposition. If we exchange it for a plant asset of a similar nature, we just adjust the basis of the new asset being acquired by any gain or loss, either increasing or decreasing. Okay. Again, if you junk something, well, we'll see the examples. They work clearly. First thing you have to do when you're disposing of a plant asset is update the depreciation expense for the beginning of the year until the date of disposition, and also update, the offset would be a credit to accumulated depreciation. Therefore, thereby updating the book value. Okay. So when we do this, the entry would be, and we'll see them shortly here in the book, you credit the asset for what's in the asset account. You debit the accumulated depreciation for what's in the accumulated depreciation account. And then whatever you're getting is going to be debited. If it's cash, it's no problem. If you're trading an asset, it would be the fair market value of the asset being received, or the fair market value of the asset being disposed of, whichever is more clearly determinable. And then any difference will go to a gain or loss account needed to make the entry balance. I said it how many times this semester that whenever you write a journal entry, the total of the debits and the total of the credits have to be equal. So if the amount to make the entry balance have debits and credits equal, if it's a credit, it's going to be a gain. If you're going to need a debit to make the debits and credits equal on the disposal, it's going to be a loss. If you don't need either or, then it's a break-even situation. Okay, so they have the thing here, Smart Touch Learning discards equipment with the cost of $10,000 and accumulated depreciation of $10,000. So its book value is zero. Okay, so they're discarding it. They show you the entry there in the tan shaded box. Accumulated depreciation, which normally has a credit balance, is debited to get rid of it. The equipment is an asset. You normally have a debit balance, so they credit it to get rid of it. And they show you the T accounts underneath it, with the blue being the entry, the posting from the entry to get rid of it. So then you have a zero balance in that equipment account and its respective accumulated depreciation. Okay. You have zero balances, they won't appear on any trial balances you do. Okay. Now, on July 1, say the equipment had a cost of $10,000, but it's not fully depreciated, and accumulated depreciation is $8,000. So the first thing they do is they bring it up to another $500 for half a year depreciation. So now you have $8,500 in the accumulated depreciation account, and you have $10,000 in the asset account. So the book value is $1,500, and again they're discarding it, so it's a $1,500 loss. They're giving up something that's on the book at $1,500, and the account loss on disposable used. There's the entry there. Accumulated depreciation is debited for its balance of $8,500. The equipment is credited for its balance of $10,000. Okay, I didn't read that second entry there, loss on disposal, because you want to block that out and you say, hey, I've got $8,500 in debits and $10,000 in credits, so I'm going to have to put a $1,500 debit in there to make it balance, and that's what I said a minute or two ago. If it's a debit the plug number needed to balance the entry. If it's a debit, it'll be loss on the disposal or loss on sale. If it's a credit, it's going to be a gain. And they show you the T accounts underneath that on bottom of page 982. selling a plant asset. So now we're going to be getting something for it. Okay. So companies will often sell. Let's see. They're saying, what do we got? Bring the depreciation up to date for half the year. So we got $8,500 in the accumulated depreciation account. Asset is $10,000. So our book value, carrying value is $1,500. And let's see. Suppose that we sell it for $1,500. Well, if we sell it for its book value, there's no gain or no loss, right? So I show you the market value of the asset received, $1,500. Book value of the asset disposed of, $10,000 cost, less $8,500 accumulated depreciation. So its book value is $1,500. That's what we're giving up. We're getting something worth $1,500. No gain, no loss. They show you cash coming in $1,500. We're giving up an asset with a net book value of $1,500. No gain, no loss. If we sell it a book value above book value, you're going to have a gain. They show you here that we're getting $4,000. Same scenario as equipment, $10,000, accumulated depreciation, $8,500. Book value of $1,500. We're giving up something that's on the books worth $1,500. We're getting $4,000, so we're going to have a $2,500 gain. I'll show you the entry down below. Cash, we're getting a $4,000. We get rid of the accumulated depreciation with a debit. Get rid of the equipment with a credit. So you'd have $12,500 in debits, $10,000 in credits. You need another $2,500 credit to make it balance, and it's going to be a gain if it's a credit. And they show you the T accounts on everything. If you sell it below book value, you're going to have a loss. Okay. They'll give you a summary when they show you the discarding, selling it, selling it at book value. I don't know if I have any exercises on that at the end of this chapter or not. Natural resources. We said things that are extracted from the earth, mined, drilled, gas, oil, coal, gold, diamonds, salt, zinc, iron ore. They use a lot of oil here. So the term we use is depletion. It's very much like identical to depreciation. It's charging the cost over its useful economic life, but you use the same straight line method to calculate it, what we call and refer to it as depletion. Now, the thing is, there's some accounts that will use an accumulated depletion account. Other accounts will say just credit the asset account for the amount of depletion. All right. It's called depletion because the company is depleting, using up the natural resources. Unlike we saw the pickup truck earlier in the chapter, we depreciated. We still had the truck. Natural resources, once you use them up, they're gone. You don't have them anymore. In fact, I over in the other room, I have my 2 old computers. They're fully depreciated, but I can still use them. They're still useful. They're not very fast, not very useful, but they're still usable. There's a lot of assets out there that have been fully depreciated that are still being used and still being used to generate revenues. What does that mean? That means we screwed up when we figured out the estimated salvage value or the estimated life. But that's what happens when you use estimates. Depletion expense is computed by the units of production method, which is a variation of the straight line method, okay? For example, oil will cost $700,000 estimated to hold 70,000 barrels of oil. Residual value, no residual value. So 3,000 barrels are extracted and sold during the year. Depletion expense is calculated as follows. I'm trying to get this thing to move down here. So 70,000 barrels into the 700 would be what, $10 a barrel? Oh, come on, look at this. Bear with me, I'm trying to scroll down the page here a little bit, and it's not responding. There we go. Wasn't responding to the arrow, so now I have to drag it down. Okay. Step 1, calculate the depletion per unit, units of production method. $700,000 cost, no residual value, divided by 70,000 barrels, $10 per barrel. Step 2, number of units extracted, 3,000 times $10 a barrel, $30,000. Okay. Our book uses an accumulated depletion account. Again, some accountants in practice are now doing away with that and just they would put a credit into the oil reserve account. Okay. So they would show the balance sheet, the cost of the reserve, 70,000 less the accumulated depletion, 30,000 net. Book value, carrying value, $670,000. Now, there's a slight variation that some companies only use the amount sold, not the amount extracted. Intangible assets. Again, these are the things that have no physical characteristics. What are we using here? Come on. Oh, jeez. It's making me curse more than I do on a golf course. Okay. Intangible assets that are purchased are recorded at cost. If it's not purchased, only a limited amount of cost can be capitalized, and they're subject to amortization. Research and development costs are predominantly expensed. The only time is if you can show that it's going to benefit a future period, then you are allowed to capitalize some of that research and development costs. Okay. Also, assets, intangible assets have to be, in fact, all assets, but again, that's beyond the scope of this course, are subject to a yearly inspection to see if they're impaired. Okay. I'll give you an example of impairment. It would be a patent, a proprietary drug, a drug that is subject to a patent. I think patents have a legal life of 17 years. We don't worry about legal lives with intangibles. We're more concerned about the economic life. But if a drug gets pulled off the market by the government because the side effects are killing people, that intangible asset, that patent, you may have $20 million in that patent, but you got to check it for impairment and maybe write it off as worthless. Okay, so when the fair market value of the asset is less than its book value, you're going to reduce it to its book value. You record a loss, as they say there. Specific intangibles. Patent. A patent has you get a right, a legal right, exclusive right to produce that item for 20 years. That's the legal life. Nowadays, very few, and keep in mind, a patent can apply to not only a product, but also a process. Okay. When you record it, you pay for whatever you pay for it, you record it at cost, and here they're saying $20,000 for a patent. So you pick up the asset patent, get rid of the asset cash for $20,000. And then the amortization, they figure, well, it's going to be useful life is 5 years, so you straight line it. Residual value is 0, so 200,000 less 0 divided by 5, 40,000 a year. But again, each year you got to, at the end of the year, evaluate it to see if it's impaired or not. And if so, take a loss and write it down to book value or fair market value. To get the book value equal to fair market value. So there you can see in the little shaded box there, the amortization expense patent, $40,000. And here we do not have an accumulated amortization account. We just do a direct credit to the asset patent. And they have that in the boulder. Companies frequently choose to credit the asset account directly because the residual value is generally 0 and there is no physical asset to dispose of at the end of its useful life. Okay. Copyrights and trademarks. Very useful things. In fact, I don't know if anybody is a boxing fan, but you probably saw him in the movies here and there. Michael Buffer, Let's Get Ready to Rumble. He has that trademarked. You know, when he's the fight announcer, when he introduces the fighters before a big match, that is trademarked. The Nike swoosh, the golden arches, you know, the the BMW, say the four rings joined together for Audi, Donald Duck. If you looked at any of your sports gear, whether it's a hat or a jersey, it'll have that, approved by Major League Baseball or the NFL official license thing. Yeah, because you're paying a lot more. You're paying a lot more. You're paying $20 for that $5 cap because it has the Philadelphia Eagles on it. Goodwill. Goodwill is a little bit weird, and it's the excess of what a company pays above market value when they acquire another. Although you can build up your reputation and say you have goodwill, but not allowable. Goodwill has some special features, like I told you. It's only recorded by the acquiring company when it purchases another company and pays more for that company than the market value of the net assets acquired. According to GAAP, goodwill is not amortized. Instead, the acquiring company measures the fair value of the goodwill each year, and if it has increased in fair, nothing happens. Again, conservatism concept. But if the goodwill has decreased, then we will write down using impairment of the goodwill by debiting the impairment loss on goodwill and crediting goodwill account. All right. So again, it's a little bit of a twist. All the other intangibles are pretty cut and dried, straightforward. Reporting of intangible assets, again, on the balance sheet, you would show them and what they're paid for them, less any amortization, less any impairment. Tying it all together, they give them the vowels there, and we should be getting pretty close to the end of the chapter. Okay, yep, here's our two ratios, or one ratio. Average asset turnover ratio to value of business performance. Asset turnover ratio, the amount of net sales generated by each average dollar in asset. How efficiently are we using our assets? Okay, how much are they generating in net sales? Okay. Turnover ratio, net sales divided by average total assets, which would be beginning assets, end of year assets, total assets divided by 2. This, like any statistic, you got to be careful. This one is a little bit more prone for misinterpretation or distortion, because if you're comparing a relatively new company with a established company that's been 20 or 30 years old, the 20 or 30 year old company, the assets were bought over the last 20 or 30 years. The newer company, they bought assets at higher inflated, prices that are subject to inflation. So you got to be careful when you use it. It is still a useful ratio. Just be careful if you're using it to compare companies at different stages of their lifespans. Okay, older companies can have old assets. I always used an example when I teach accounting theory and thought on the MBA level. Twin brothers. One brother went into the Air Force. The other brother went to Hollywood, and he had a 57 Thunderbird automobile that he rented out to TV and motion picture companies to use in their films and shows, and he was doing real good. And the other thing is he bought it in 1957 for $3,500. Well, his brother retires from the Air Force and moves out to be by his brother. How are you doing? I'm great. I have more work than I can do. Oh, yeah, what are you doing? Well, I'm renting that Thunderbird out to TV and movie companies. Oh, yeah, well, maybe I'll do the same. The only thing is he goes out and buys a 1957 Thunderbird now, and it costs him $100,000. So you have two companies with identical assets. One is old, one is new. They're still capable of generating the same amount of revenues, but one has got $3,500 and is probably fully depreciated. The other one is $100,000. So that's going to monkey up this ratio a little bit, the asset turnover. Just be aware of that fact. I think that's it. Yeah, there we go. All right, a little bit lengthy on this one. Yeah, hour and 40 minutes. Because I had to move out of the sunshine. So again, now you're seeing the rest of the room here. Finally, after how many weeks, there's the side yard, the front yard, and the back wall. So now you have a tour of the whole room. Okay, we'll be getting another one out probably Friday night of going over the exercises and problems from chapter 9. Review question, short exercises. I don't know if there's a problem or not. Okay. I'm going to be signing off for now, and watch for the Chapter 9 video that goes over the solutions to the end of chapter assignments.